Hello, and welcome everybody to this week's Freightonomics Leap Day.
It is Leap Day.
February 29th. It only happens once every 4 years. I don't know that you know that.
I do know that, but I looked at my watch this morning and it was off a day. It was not.
Didn't know?
No.
Does it not have a...
Well,
that is a hard thing to program into, I guess, mechanical stuff.
Yeah, it was off, but it's okay.
Yeah, happy Leap Day, everybody. And I know there's a lot of transportation service providers that prefer it not to be an extended February.
When you look at this market, it's not where nobody had fun in February.
Yeah, they were like, can Leap Day happen on a year that the freight market is strong?
I guess, well, it happened in 2020, but at that time,
it was not.
It was not.
No.
So
2016, 2020, 2024 thus far have all been relatively disappointing.
Yeah.
And they're all leap years.
Interesting.
I just figured it out, guys. So watch out 2024. There's the financial advice for... So yeah, this is probably a good time to just go ahead and kick it off with the freight market update, the market in two. If you want to count me in, we'll set the tone here, and then I want to go back to a few of these.
All right, Zach. So in 3, 2, 1.
All right, first one up, the NTIL, which is the average aggregated spot rate for dry van freight moving more than 250 miles, based on our trusted rate assessment consortium. At a high level, excluding the total estimated cost of fuel. So we get all that fuel noise out of there. There hasn't been a lot of that lately anyway, but this peak to a complete decline. This is what a lot of transportation service providers are feeling right now. It's going to feel much more harsh than it actually is. Looking at the short-term trend, we have plummeted, over the last... since February started, so we're finishing February right now, but still elevated above where we were for a large portion of third quarter and the second half last year. So there is some optimism there, and I think this is also just the spot rates can always drop while there is abundant capacity. We always have to keep that in mind. I think the trend line has been shifting a little bit higher, but you got some emotion here that we're capturing, especially since February is not exactly the best month for freight. However, let's go to the next chart. OTRI, Outbound Tender Rejection Index. It took it a little bit longer, but it's still, it's plummeting too, but we're seeing a little bit more stickiness in the OTRI. This tells me that the spot rate might be a little bit more exaggeratory because of that emotional sentiment. OTRI, of course, the tender rejection rate from shipper to carrier as carriers are rejecting those tenders. This is still relatively high compared to where it was most of last year. We averaged 3.6%. We're still at 3.9%, and we averaged a good chunk higher through most of February. So not necessarily as bad as the spot rate implies. Let's go to the next one, OTVI. This gives me a little bit of optimism for the freight market in March. Look at that little spike there. Looked like things were falling down, but demand is actually on the up and up. Hard to tell, though, considering the oversupply.
Yeah, it's not really felt, and I think that's the takeaway. But and
a lot of this freight is short haul. Like a lot of that volume spike is in the short haul side. So this is some repositioning, upstream activity, far downstream activity, retailers maybe repositioning some things.
Yeah, and that's where I think going in and looking at market specific and figuring out what markets are causing this increase, right? Because we can look at it on a national average. Just because it's on the national average doesn't mean you're going to feel it. Like maybe you won't feel it or see it in some of even the larger markets, right? Like go look at, I know we see some of these spikes all the time and you see it happen in areas like Phoenix and you see it happen in areas like Detroit. Yeah. So again, shorter haul freight.
So Phoenix, of course, like the new warehousing place to be in the United States. I think Laredo may start joining that fray soon. But we've seen a lot of short local moves in Phoenix as that market has also expanded over time to be kind of the new inland empire, if you will. And then, of course, Detroit, automotive capital of the country.
Yeah, you have a lot of movements between suppliers and and like the big three, really. And then you have a lot of movements cross-border that are very short haul, right? Because, there's assemblies that happen. So it's just like this, Detroit's an interesting market, but you will see spikes like this regularly as freight or manufacturing either comes online, suppliers finally have stuff to move, right? So,
well, automotive supply chains too. You have these assembly plants, these huge, massive assembly plants, but they position all their suppliers
right around them.
So you have this long haul freight come in to the individual suppliers, and then there's a huge amount of activity in the short haul sector there, where they're bringing in components to the assembly plant because it's largely just in time still. And so they want to keep that position as close as possible because service disruptions aren't as big of a deal.
Yeah, exactly. I mean, the risk of shutting a plant down because a delivery was missed is a lot less, and like the risk is less than it is if you're having to move something 500 miles and there's no telling what the driver encounters across that length of haul that could delay.
I mean,
it doesn't even have to be 500 miles.
No.
It could be 100 miles, right?
And I mean, I know the plows and everything are much more effective up there than they are down here in the south, but weather does still hit them pretty hard at times up there, and you want to have that length of haul be short as possible. So I think, Tony, my take here is it's near-term pain for a lot of transportation service providers, but I think this type of thing can actually create more likelihood of a pretty violent turn in the long run.
Yeah, because I mean, if you look at volume, the volume chart, I mean, look at where February from a volume perspective, like it was down for much of the month. We're going to end up higher than where we started. I'm actually writing an article right now looking at port numbers, looking at like New York, New Jersey, strong growth year over year. I mean, 5.8% in January.
That's kind of a quiet, I'm glad you called that out. That's kind of a quiet outlier that nobody's paying attention to. The narrative has been everything going to the West Coast, and it has largely done that.
Yeah, the growth numbers on the West Coast are much larger than what they are on the East Coast, but you still saw growth. I mean, loaded imports into Port of New York, New Jersey were up 5.8% year over year. And yes, we can argue 2023 wasn't good, but you're still seeing growth. And I think that's the takeaway. It's like that growth they haven't lost everything that they gained throughout the pandemic, has not shifted back.
Yeah. Well, with
the disruptions in the Red Sea and the Panama Canal, I think it just highlights that there's still some degree of using the East Coast you saw shifts, and those shifts have maintained themselves to some degree.
Well, from a domestic transportation perspective, when you have this, one side heavier than the other, situation where, if we have these shifts in preference that they create imbalances.
Yes.
And one of my big risks for 2024 this year is watch out West Coast. We've had a lot of that market share go back to the West Coast ports. If people aren't diversifying their port exposure, and the capacity is not going to be there, like when they turn it back on. Like when they start bringing stuff in mass, maybe some of that share goes back to the East Coast. Where are the carriers going to be? Like, especially when we're dealing with like 5 to 10% less carrier base.
Yeah, because like you said, I think a few weeks ago, I mean, what is there between Dallas and LA? I mean, it's a desert. There's
the freight desert.
Freight desert. I mean, it's a real desert too.
Yeah.
I mean, there's not a whole lot.
Not a lot of moisture.
Yeah, there's not a whole lot there, right? So, I mean, you start reducing the amount of carriers. I mean, it becomes more cyclical in terms of like, and you've seen it if you go and look at tender rejections in LA, like they're amplified, like the wavelengths have amplified.
Yes.
Kind of this indication that capacity one is more sensitive to movement, but you can kind of see the flows of when carriers are coming back, they're coming back into the market, when they're leaving, right?
It's hard to get there. There's much less freight going out there than there is coming out in general. And we, of course, measure that in Sonar. Tender data, it's very apparent out there. So the one chart I didn't show, the carrier details, trucking authorities versus the OTVI, if we go ahead and pull that one up, this is why I think these types of environments lead to violent shifts later. We're looking at carrier details, total truckload authorities in white. So it's measuring FMCSA data of MC numbers for motor carrier property, active. And they do a little bit of extra work here to make sure it's a little bit more real time. And then OTVI, which you're familiar with, the tender volume index that measures truckload demand. You can see truckload demand is going up, capacity, at least active operating authorities, coming down. And that's just we are moving towards equilibrium. We may not feel it yet. But when we have these markets where we have these violent shifts where the spot rate, because a lot of these operating authorities are small carriers, owner operators, they're very exposed to spot market trends. When you have the spot rate fall off a cliff like we've had, that leads that creates that violent emotional like response. And a lot of carriers are just like, you know what? This ain't for me anymore.
Yeah. Yeah, it's one of those things, right? Like during the pandemic and the bull run after that, right? Like the spot rate stayed so high, they knew it was kind of in this element. Like they're like, oh, there's some momentum. They built up these like war chests, right? When we've talked about it, that's why you see such a slow decline. Is surprisingly, we thought that the decline would be faster in authorities, but where rates were throughout this time frame, the pandemic time frame, I mean, 21, 22, I mean, you're talking growth and the ability to build cash reserves. This short-term like spike that we saw followed by this rapid decline. I mean, it literally fell off. It looks like it fell off a cliff. And you kind of talked about it. It's the emotion side, right? Like there's never really been a good way. It's the way you can gauge emotion in the market versus maybe strictly fundamentals, where volume and rejection rates can kind of trend more on the fundamental side. I think you look at it and you're like, well, you can tell the emotion is not great at the moment.
Well, it's exactly the response I would expect after kind of an overheated winter situation. Because really what we were seeing a lot of that is like us just coming off of an unnatural high. Yeah. Like,
yeah, you should have seen, like,
if we pull that chart back up, the NTIL chart, so everybody knows what I'm talking about here, the first chart on the.
Yeah, I mean, in January, you shouldn't see an increase.
Yeah, spot rate's higher than Christmas in the middle of January.
It's not real. It's not normal.
It's not natural.
So really, I mean, where you see the decline to and where we're at now, I mean, it's kind of the trend line we were on. And then we saw the winter weather hit, and it created the increase effectively.
And I think we're seeing the spot rates actually go lower than they might have gone without that winter weather.
Yeah.
Because you create this like expectation. Everybody feels good about it. And then all of a sudden, oh, it's going back to the way we actually thought it was going to be. And that creates that really aggressive bidding posturing.
Yeah. Again, this is carriers bidding against themselves, right? I think that's the part that gets lost a lot of times when you see it on social media that the brokers are the bad guys pushing the rate down. And to some degree, they do try to lower their costs.
Yeah.
But if you don't take it, somebody else is going to come in and take it for a lower rate than you are. So like they end up, the carriers bid against themselves in this situation too. And I think that gets lost sometimes in the emotion.
Because the brokers they have better access to networks.
Yeah.
They can, since they're the ones with the largest carrier bases, instead of it being a single network that a carrier has imbalance in, now they can look and identify where the other carriers' imbalances are and take advantage of those rates that are lower.
Yeah.
And that's what they're doing. They're just kind of piecing together.
I mean, they're looking at 100,000 carriers, right?
What makes the most sense. And that, of course, does drive the rate down faster because they are making it more of a competitive marketplace.
Yeah.
That's how markets work. And that's been the case for years. This is not new, but I think we are seeing a space where, one of the biggest points of feedback is, are we in a race to the bottom? And I think the winter weather event has made it worse.
Yes.
Even though it felt better for a minute, that kind of pushed people into this mentality that, they're getting better. This isn't going to be as bad. Now that they're back to where they actually should be, it feels a lot worse. It's like walking outside in the spring and you feeling 70-degree days. Yeah. And it's like, oh man, it's hot today.
Yeah. Earlier this week. Yeah. I mean, but I think about it in the stock market too, similar situation, right? When you see things push up in abnormal ways, that pullback is super aggressive. And it churns out some of the, I mean, I don't want to say it churns them out in this market, but it does. You'll see 20% reductions, 15% reductions, and they're very fast and they're very aggressive, and it sets up for a long increase, right? So it's kind of a similar idea in a more cyclical environment.
And I think this is overreaction too, because we're seeing demand not fall off a cliff.
Yeah.
Like this is absolutely some level of emotion.
Yeah, and it's not, you look upstream and demand's
No,
right? And
we're doing all right. Actually, the signs of spring are there.
Yeah.
OTVI, it's about to be the first week of March.
Yeah.
Tend to see that spring demand kick in. It may not always land on the same exact week.
And then you have the end of the quarter coming up in the end of March.
Quarter in March. The spring volumes really kind of kick off the home garden stuff.
Produce. Early produce. I mean, it's early.
It's too early probably, especially this year because of the rains in California. But for sure, I mean...
That goes into some of the emotion, though. Like, you think it's coming, so it helps drive some positive sentiment, right?
And when it's not there, then you feel even worse.
Yes.
If you're expecting it to be 70 and it's 30, it feels worse. And I think that's what we're dealing with right now because the signs of spring are there. The demand is not falling at any point. But I want to transition into the news because I think this is a good segue into John Kingston's story that I really love that he covers with this BMO transportation group that, really monitors credit in the trucking industry in Canada primarily. But BMO's earnings show a lot of credit deterioration. And they have a chart. He has a chart in here that I think just you don't even have to know what it's measuring, but it correlates effectively with delinquencies in trucking. They're on the rise. The amount of money, it's in Canadian dollars. Check it out on freightwaves.com if you want all the details here. But look how exponential or parabolic this curve is.
Yeah, that to me, knowing what this measures effectively, that's going to be your rate of exits out of the market or the way that they're headed, right? Like there are people that have effectively defaulted on their loan and the banks accepted the fact that they're likely not going to recover that money.
And I think my takeaway here is that 2023 wasn't as bad as you think it is.
Until the end.
The very end, we're actually on kind of a linear path through most of 2022 was fine. And then we take this linear regression path through the first couple of quarters, and then all of a sudden it's parabolic.
Yeah, I think people have started to realize, and some of this comes into timing of when do loans go into effectively default, right?
Sure.
So, even if you said 60 to 90 days, you're talking if things started getting bad in Q2 or Q3, like it really starts showing up in Q4, Q1 of this year. So it's like the timing of it makes sense that, okay, things got really bad likely in the middle of 2023, which we've talked about ad nauseum here, right? And it's starting to really show up. And I would expect you may even see this get more aggressive in the coming quarters.
And all that tells me is that what we saw in that curve with, the operating authorities versus demand is that the supply side portion of that is starting to turn downward faster.
It's set for...
And that is, you see how slow this is.
Yeah.
Like we've been in a down cycle for transportation service providers for 20 months. And we're just now getting to the point where it is increasing significantly at the end of last year. So in the end of last year, we saw it wasn't good, historically speaking, from a rate standpoint, but it wasn't like there wasn't any dramatic shift downward.
Yeah. And I think that was the positive side for those in the market, right? Is that we didn't see the aggressive downward move really in the quarter. And it's more from a volume perspective. And I think you start looking at volumes, like I wonder how much of that, obviously OTVI is really heavy, more leaning into the contract side of the market. And you look at rejection rates, sub 4%. So not a lot's flowing into the spot market.
No.
So those smaller carriers that are exposed are getting less freight at lower rates. It accelerates the need to get out of the market if you think of it as a kind of a plan of last resort. But it sets up, like you said, the more aggressive on the other end, because I think that's really the idea. I think this is something interesting I've thought about recently, is that the more data that you add into a market, the more aggressive the swings are.
They are.
Because you're making decisions
quicker.
Yes. Yeah. You're not seeing the change happen 2 weeks ago. You're seeing it happen as it's changing, and it makes this.
Well, most brokers look at rates. Every day. So that's what changes fastest.
Yes.
Is the rates, because that's what they're looking at. And That's why it's important to monitor rates.
Yep.
There is another story, and I'm going to skip over the two that I think I was going to talk about, but I think this is more relevant to what we're discussing currently. Morgan Stanley cuts earnings expectations amid surging insurance costs. Now, we just had some people go to RELA out in Texas, the retail association out there, and a lot of the feedback was centered around, especially the carrier base, was around just exponential insurance costs.
Yeah.
There is a lawsuit out there pending. It's a big one.
Yeah.
It's one of those nuclear verdicts. Werner involved in that. And it is, if it goes through, I mean, again, I'm not going to get into whether this means that our legal system needs some work or not, because it absolutely does.
Yeah.
But $100 million lawsuit out there. It's not the only thing that's occurred over the past several years, but if these nuclear verdicts, which are, explained well in some of our articles here, but if they go through, the insurance companies that goes into their algorithm for risk assessment.
Yeah.
And that means that insurance costs rise.
Yes.
This is not nuclear verdicts are basically company enders. Like, you go under because they're too big. They can't be paid. That's another reason why that's irresponsible.
Yeah.
Like, you are not making the world better. You are actually eradicating economic value in the sense, and I'm not trying to belittle the damage caused, but there was actually, like in the Werner case specifically, there's actually no fault to the trucking company. It's just people don't like trucking.
It's easy to chase, right?
Yeah.
I mean, you see the billboards all drive. I mean, I can think of driving down I-75 from here to Florida, and I mean, you see them fairly regularly. Injured in a truck accident, like, call us. And it's like,
this is bad because
they're almost like ambulance chasers, but they solely target trucking.
This type of thing is not just bad for carriers; it's bad for all of us.
Yeah,
this is artificial inflation.
Well, yeah, because it in turn, right, a carrier is going to, if their costs go up, they're either going to go out, which limits the competition in the market, which limits supply, which pushes prices higher.
Yeah.
If prices for transportation go up, that will flow through. It flows through. It doesn't go to the company that's paying for the transportation. Effectively, it goes to the good. It flows into the cost of the good that is either bought by the consumer at some point, or a manufacturer or something like that, where the input gets pushed down to the consumer. And if it's higher on the input side, it's going to be higher at the consumer side. So it's like this, it's a long-term thing that happens. Like, it doesn't happen overnight. Well, I shouldn't say that. I mean, look at COVID. You saw the rate at which transportation costs skyrocketed, and the speed at which it got passed through to the consumer was rapid. But this is a longer term thing than the COVID disruption was.
But if something were to occur here, that CDNCA number would tank.
Yeah.
Because this disproportionately impacts the smaller carrier.
Yeah, and that's been one of the highlights, is higher insurance costs to driver for carrier exits. And this would accelerate
and not just carriers, but brokers.
Yes.
Brokers will have to feel this burden as well.
Yes. Yeah, I mean, overall, it's just, I understand the cutting of expectations because of it.
100%. They're all.
I mean, it's all. Everybody's exposed to it, though. It's not just those public companies, right?
So from a shipper perspective, like, knowing this is a thing. Like, we just talked about a bunch of significant downstream risk. I know we've been talking about this a lot. If you watch FreightWaves, hear FreightWaves, read FreightWaves, this has been kind of our narrative. Now, it doesn't necessarily mean we're going to be right that it happens this year. But I think, the timing is always the hard part to call.
Yeah. And we did a survey and put out there doesn't seem to be a lot of risk mitigation happening in the transportation market. And that's the concern. It's not that, it doesn't matter the timing. If you're not trying to actively mitigate any risk to your network, you're going to end up the whole bullwhip, really. I mean, that's a similar, not exactly what it is, but similar concept, right? Like, if you're not mitigating the risk, that upward move is going to feel a lot more significant.
Oh, and if you just locked in rates based on the bottom of a market, you're at risk. You are at, you might as well just lock in a, whatever period it takes. Like, maybe you make it to the end of the year. I don't know. Like, I don't know.
If you do, good for you.
Yeah.
But like that next round is
all the data suggests we are headed towards a pretty strong shift and balance in the freight market at some point in time. And it may not be like a COVID style-esque thing, but if you're not preparing for it.
Yeah, and clearly the demand side isn't going away. Like that's, you would have thought it would have already started to trickle away, and it just hasn't. And it's going to be.
Yeah, we thought the economy would kind of fall off last year, and it just didn't do it.
And guess what? If the Fed cuts rates, it's a demand. I would think demand goes up from there.
Yeah, the industrial sector still looks good. Anyway, hopefully everybody starts. What was it? The ant and the grasshopper? Be the ant.